Hi, this podcast is going to deal with operating leverage, but really I've split operating leverage into two podcasts, so they're not so long. This one's gonna focus on how we calculate break even. So for those of you who've taken managerial accounting, you recall break even analysis and managerial accounting. This will all seem very familiar to you. Okay, so first let's talk a little bit about operating leverage. Operating leverage deals with the firm's operations. So this is our income statement items that relates to sales, costs of goods sold, operating expenses, everything through EBIT. And so the risk in operations we call business risk. Remember the other financial leverage related to financial risk. And there are many reasons that we can have variations in earnings per share. in EBIT. Changes in sales, costs, etc. So operating leverage, as you recall, deals with our cost structure. So our mix of fixed costs and variable costs. Fixed costs, you recall, do not change with the level of sales. So our fixed costs are the same regardless of our volume. These include things like rent expense, depreciation, utilities, salaries. Variable costs, then they do change with the level of sales. So direct labor, materials, commissions, things like that. Break even, in order to do break even, we need to determine the level of activity to stay in business in the long run. And so one of the things break even does is tells us what, based on our current cost mix, what volume would we need to achieve to break even. Kind of should have probably had those slides back different. So graphical of the fixed costs. All right, here's our cost. It remains the same over our level of volume. Variable cost, total variable cost increases with volume. And then total cost, note that total cost is fixed cost plus variable cost. So it doesn't start down here at the origin. It starts at fixed costs and goes up from there. This is a break-even diagram. You've probably seen something like this before. So our revenue is in red, right? At zero quantity, we've had zero revenue. But as we sell stuff, we earn revenue. Our costs come across here, and where those intersect, we call break-even. So break-even analysis, the way we commonly do it is using the contribution margin. The contribution margin is the difference between our sales price and our variable costs. And so we can express contribution margin per unit, sales price minus, you know what, I shouldn't have said per unit there. Actually, there's a couple ways we can do this. So we can do this in total, our total revenue. Well, no, this is price. Well, I'm just going to tell you. So we can do this per unit. Okay, you with me? Everybody's with me now. So we can do it per unit, and that is price per unit, right, minus variable cost per unit, gives us contribution margin per unit. We can also do this in total. In that case, it wouldn't be price, it would be revenue. So total revenue minus total variable cost gives us total contribution margin. And then we can also express that in terms of a ratio. And so if we take contribution margin divided by price, then we get this contribution margin ratio. So let's look at this pretty simple example. The company makes a unit and it costs $7 in variable cost, and they sell it for $10. What is the contribution margin? And I don't really like the way they express that. What is the contribution margin per unit, and what is the contribution margin ratio? That would be a better way of expressing it. So the contribution margin per unit, 10 minus 7 is $3. What is the contribution margin ratio? It's that $3 of contribution margin divided by price of 10, or 30%. And when we're doing break-even in units, break-even Wish I had a better way of doing this than with my mouse. Break even in units, we use this one. We use contribution margin per unit. And when we do break even in sales dollars, let's pretend that's a dollar, we use this one. I cancel out of that before I screw something else up. Okay, so break even then can be expanded on. This formula doesn't need to be as complicated as it looks. So a break even in units, that's what this is, break even in units, is our fixed costs divided by our contribution margin in unit. So you can go ahead and write that down. I'm hopefully explaining it in a little simpler terms than what you are seeing here. So break even in units is our fixed costs divided by our contribution margin per unit. Our break even in sales dollars is our fixed costs divided by our contribution margin ratio. So that ratio we just calculated in the previous slide. Fixed cost divided by contribution margin ratio. And here's an example. So again, same thing, revenue or price is 10, variable cost is 7, and our fixed costs are $1,800 a month. So $1,800 a month divided by 3, which is our contribution margin per unit. We have to sell 600 units to break even. Calculating break even in dollars, well, the easiest way to do it then is just multiply the 10 times the 600 units to get $6,000. But sometimes if you're not given that information, you have to use this other formula, which is fixed cost divided by contribution margin ratio. Remember the 30%. So 1,800 divided by 30% is also $6,000. So we got to sell 600 to break even. All right, that concludes the podcast on break-even analysis.